this is a natural progression for Carbon Tracker's work. So in 2011, we sort of introduced the whole concept of unburnable carbon and what that means. 2013, we took the sort of industry-wide look at wasted capital and how that sits between different stock exchanges and different parts of the world. And now we are drilling down into the detail. So looking at each individual project and therefore by implication each oil and gas company. So I don't think those companies can now hide behind each other or behind the industry as a whole, because this analysis, the granularity of this analysis, shines a very bright searchlight, if you like, on those companies that have some questions to answer.
The key for me is that it means that the oil industry can no longer plan on the basis of business as usual. Most oil companies assume oil prices will remain at roughly the levels they are at the moment. The conclusion of this report, which is that demand under a 2-degree scenario will be much lower, by implication means there will be downward pressure on oil prices. I think the industry so far has failed to take that into account in its scenario planning. I really do believe they need to start looking at a tipping point scenario whereby we could be talking about much lower oil demand caused by very high prices of carbon. The key issue in this report for me is that it combines an analysis of carbon together with an analysis of the returns of various oil projects. What that does is it gives investors the ammunition they need to engage with the oil companies. So rather than having a debate along the lines of you can't burn this carbon and the oil company saying yes we can, you have an argument about you mustn't burn this carbon because it is low return, high cost, and therefore puts our capital as shareholders at risk.
I think the last report that Carbon Tracker produced was very helpful in motivating interest in the investment community in the area of stranded assets and unburnable carbon. The new report really takes things forward by changing the subject to focus on demand risk. The idea that in a carbon-constrained world, oil demand might fall and oil prices might fall. And that brings the debate right to the centre of what investors care about in the oil industry. They really care about oil prices.
Now we're really looking at the balance sheet of these investments, and it's something, frankly, that fossil fuel companies really need to stand up and consider very seriously. Because this deep dive, as Anthony has called it, really not only does it now question the wisdom of indiscriminate investments in fossil fuels, it actually debunks the myth that those investments continue to make sense, even in the absence of policy.
You can't hide from the numbers, and I think what the numbers are showing is there's a significant proportion of projects which have serious financial questions to answer. And I think two key things actually come out of it for two audiences. One is the financial markets, that there is a significant proportion of those projects that are a bet on the oil price, pure and simple. The second message, I think, for the sort of broader audience, provides a tool so that we can actually see where, which projects you need to take off the table if we're going to meet the 2 degrees sort of threshold.
The new Carbon Tracker report focuses our attention on the particular fields which are highest cost. So we can now go and talk to the oil majors about how they are going to develop their CapEx strategy to address the risks in these particular high-cost regions. The CapEx question for the independents is going to be more difficult. I think for some of the tar sands companies, the oil sands companies, there are strategies for rather than investing large amounts of capital in very big developments in oil sands, to do it in a more piecemeal, incrementalist fashion, which reduces our capital that's exposed to risk from potential stranded assets.
You are not just showing the very critical analysis of profitability, profit and loss, and wisdom of CapEx into these particular investments, but that you're very constructively providing a very responsible pathway. Because I do agree with you, Anthony, we are not going from Tuesday to Wednesday or Wednesday to Thursday to deal without fossil fuels. In fact, we will have some fossil fuels even in the long and even in the medium and longer term that will continue to be in the energy matrix. So the question is, how do we begin to take out those that make least sense And that is where this is a very helpful analysis, and thereby begin to weed out slowly and wean ourselves as a global economy from our dependence on high carbon, but in a way that makes sense to those that are putting up the capital, to those that are exploring and exploiting the resource, and above all, to all of those who live on the planet.
I think the issue for the market is at the moment there is not a wide range of engagement between all classes of investors and oil companies. I think the market will now understand that it has the ammunition it needs to go and talk to the oil companies, and that ranges from the oil majors down to the independents. And you can start to have a rational argument which the oil companies can't hide from.
I think the market's going to be extremely interested because to date no one's done this sort of comprehensive assessment, and for the first time it sort of lifts the curtain, I think, on the whole issue of capex in the oil sector. So they'll be looking at this very closely. I think probably asking the companies in which they hold shares some very probing questions.
One of the most interesting things that the report shows us is that the oil majors, with whom we've been having the most extensive conversations about stranded assets, are perhaps not the companies that are most vulnerable to the problem. The report makes it quite clear that the companies that are most exposed to high-priced oil are the independent oil companies. If we go and talk to independent companies who only have one or two oil fields, perhaps in Canadian tar sands, their whole company is exposed to this risk. And I think we're going to now start engaging with those companies to see what strategies they can adopt to be flexible about their future capital expenditure to reduce their risk in this area.